Hello everyone, the stock market pushed higher last Friday after going through a shaky week. S&P 500 was trading at a tight range for the entire week. This means bulls and bears were fighting each other as they sought to dominate the other party. At the moment, we don't have a clear winner yet. So who will eventually emerge as the winner? Honestly, I don't know as I don't have a crystal ball, but will the market find its direction in the upcoming weeks or week? Possibly, simply because it cannot consolidate at a tight range forever. Therefore, watch on this video to find out more as I identify some key events and technical levels to keep an eye on. Okay, so last week, all of the major indices posted losses, but they are still positive for the month. Generally, S&P 500 has been relatively flat since the rally we had from October's CPI number. The rally couldn't sustain likely because investors are starting to rethink their expectations of a bull run after several Fed officials came out to speak last week. For example, two Fed officials said the central bank is looking at a benchmark interest rate of around 5%, higher than the current targeted range of 3.75 to 4%. In fact, one of them, James Bullard, shared that a range of 5% to 7% may be needed to bring inflation down, definitely higher than what the market is pricing in. Other Fed officials also shared that they should not stop until it's clear that inflation has peaked and that all possible increments of rate hikes were on the table for the Fed's December FOMC meeting, including a 75 basis point rate hike. All these comments have more or less caused the markets to be divided. It's like on one end, the market wants to go for a traditional year-end rally with a good CPI number, while on the other hand, we have the Fed coming up to spoil the party. What didn't help is that the series of earnings from the major US retailers were showing mixed performance. As such, the market is a little stuck in the middle at this point. For the week ahead, do note that it will be a shortened trading week due to Thanksgiving on 24th November. Prior to that, the meeting minutes for the last FOMC meeting will be released on 23rd November, and investors will be hoping to get some clues on Fed's thinking on the near-term monetary policy. That being said, I am not expecting too much surprise from these minutes. Personally, I think the market is digesting some of the data, earnings, and Fed's comments that were out in the last 1 or 2 weeks, and will continue to digest them from now till at least early December. In my view, very soon, the market will be back to reality as investors realize that inflation is likely to remain high and that 1 month's worth of data is not enough for Fed to pivot. With this being said, I am not expecting S&P 500 to create a new low till the next FOMC meeting and CPI data. In case you are not aware, November's CPI number will be released on 13 December, while FOMC meeting is scheduled for 13 and 14 December. The market could just chop around a consolidation range leading to these events, barring any major events or news. And for the market to have a breather or even the usual center rally at the end of December, we will need another good CPI number and also signals from the Fed that they are slowing down the rate hike. So that was the market outlook for the upcoming weeks. Let's move on to the technical analysis portion. SPY, which represents the broader market, seems to be holding up quite well at the moment. Ever since it broke above the 389 resistance level that I have previously shared, it has been staying above it. If you recall, I also shared that in Fibonacci retracement level context, the 61.8% level is a critical one, and in this case, it's 398. Evidently, this has posed as a huge resistance for the last 1 week as SPY floated around this range, but could not stay above it. Another huge resistance is the 200 moving average, which currently sits at 403. I have posted on Mumu that these two levels form a range, which is 398 to 403, and for the market to have any meaningful rally, SPY needs to break above this range. At this point, I think it's quite an uphill task. I don't know, probably good news from the next CPI number could help us to achieve that. But you get that, below this range, the market looks bearish. I wouldn't buy any call options. On the downside, 389 should act as a support together with the top of the Ichimoku cloud. But I would say a stronger support is around 377 to 379 as there are two support levels there, which are the 50 moving average and the 38.2 Fibonacci retracement level. Not to forget, there is a gap between 381 and 385 that could serve as a magnet to pull SPY down once 389 couldn't hold. Alright, before we move on, can I trouble you to help me hit the like and subscribe buttons please? This will really help to boost the YouTube algorithm. Okay, finally, just wanted to say bulls were in control 2 weeks ago when CPI printed good number. But just last week, the broad market entered a stalemate. In other words, both bulls and bears are evenly matched. As you can see from the weekly chart, there was a long-legged doji candlestick formed last week. This means there is indecision in the market as the market opened the week at 396.6 and closed at 396.03. So it really depends on how you see this setup. Some may say that bears are gaining strength after the CPI print, while others may say that bulls are defending well. I'm sorry that I cannot give you a definite answer on who's winning as I am just reading off the chart. That is why it is important to keep an eye on those support and resistance levels when the market opens next week, as we aim to identify the next direction. Last but not least, about 2 videos ago, I shared that the 50 moving average is about to cross 100 moving average on the weekly chart. There you go, it has happened, and to me, that's a bearish sign. To also share, the last time it happened, it was in 2008, and the market crashed quite significantly. Not saying it will happen again, and just presenting the fact. Moving over to Apple, huge resistance can be expected at 154 to 155, where the 50% Fibonacci level and 200 moving average are. If this area breaks, we could retest the crucial level of 160. And if 160 breaks, I think the upside could be quite significant as we could potentially push towards the top of that red dotted downward trend line, which is around 168 to 169. Anyway, if I were to look at most of the big tech firms, I think Apple stands a higher chance of breaking above the 200 moving average based on their performance in this year's bear market. As you can see, they went above 200 moving average a few times, stayed for a significant amount of time before coming back down. That is the period where bullish core buyers can make profit in a bear market. But a quick disclaimer, not saying it will happen again because past performance doesn't guarantee future results, and therefore I would suggest viewers to do their own due diligence. Alright, on the downside, 144 should offer some form of support. Below that, we have a gap at 138 to 139 pending to be filled. Similar to SPY, if there is no major catastrophic event or news, I think the probability of Apple closing below the gap is relatively low from now till the next CPI print. Again, this is not a financial advice as I could be very wrong. To be frank, deep inside me, I hope I am wrong and I hope Apple can dip to 138 or even 135 again so that I can pick up more shares. On the weekly chart, can you see that green dotted support trend line that I have drawn? It's around 137 to 138, sort of coincide with the gap that I shared earlier, and this area seems to be a strong support as it tends to bounce back up most of the times we hit it. There was only once where we closed below it this year, which happened in June. Next, let's have a look at the popular Tesla. Very interesting chart here as it shows mixed signal. Let's break them down. On the weekly chart, there seems to be a huge head and shoulder pattern that stretches all the way to November 2020. This pattern is a bearish sign. The neckline is at around 195, give and take a little bit. And at the moment, it seems like Tesla is breaking below this neckline. If this breakdown continues, we could go all the way down to test the 200 moving average of 160 or even the next consolidation range of 150s. On the daily chart, if you have followed my previous videos, you will know that I have identified a huge bear flag and Tesla broke down from it. And right now, if you look at it carefully, there seems to be a mini bear flag formed and Tesla seems to be breaking down too. That's another bearish sign. Okay, if you have learned something to this point, could you help me with the like and subscribe buttons? I am hoping to hit 500 subscribers by the end of the year. Anyway, pay attention to 175 to 177. If we were to close below this range, I am seeing little support till 150's range. But then again, it is not guaranteed that we will slide to that level, alright? It's all about probability. On the other hand, last Friday, when Tesla tested and broke the recent low of 177, it actually bounced back up to close at 180. During this process, there is a possibility of a mini double bottom form here, which is a bullish sign. But however, this is not confirmed yet, so do watch how Tesla moves next week. I think minimally, Tesla needs to stay above 185 for at least 2 trading days to gain some bullish momentum. As Tesla is a very volatile stock, I personally would want to see it break and close above 200 again, before we can confirm the mini double bottom, and to unlock more upside to around 209. To sum up for Tesla, if I were to just purely read off the chart, the 2 bearish signs that I have identified are playing out stronger than the bullish sign. That said, a huge caveat here, please stay nimble. Things change overnight, let alone weeks or months. Maybe, just maybe, Tesla may just retrace up and then come back down again. Let's now take a look at Microsoft. It is also looking interesting as it trades at a tight range formed by the 50 moving average and resistance level of 240. Something that caught my attention is that the last 2 occasions when Microsoft broke above this 240 resistance, it came back down again. So will it happen this time? I'm not sure. But in order to break free from this trend, Microsoft needs to retest the 250 level and close above it. That will then give us some possibility of filling that gap between 259 to 264. On the downside, support is at 240 and the 50 moving average, which is 237. Do note that there is a gap at 227 to 234. Personally, I wouldn't sweat if Microsoft fills this gap as the huge support is actually at low 220s. But what if Microsoft breaks below 220s? Well, I will pick up more shares, as simple as that. Finally, we have Google. Google actually had an amazing recovery from its recent low of 80s. I think it's more than 15%. As you can see from the daily chart, 100 seems to be a huge resistance level to cross. Once broken, we will likely feel that gap between 100 and 102. I will then likely be selling a cover call around this area, as I think at this point it will be quite tough for Google to go even further to break above the second resistance level of 105. Well, I could be wrong. On the downside, there is a gap between 89 to 91, with 90 as the main support. This is actually a crucial area to defend, as the next consolidation zone is between 85 to 90, which we briefly entered for a day or two, and Google rebounded quite quickly. Personally, I think that's quite a good entry point for long-term investors. Alright, some end thoughts for this video, but before that, just wanted to share that I will be away next week, so there will not be any video. The next video will likely be on the following Sunday, which is December already. Therefore, I shall break down 3 key points for investors to note before my next video. Okay, number 1, the market can cheer and get excited at a good CPI number all they want, and we can have our year-end rally. But I think it is important to remember that we had a close to 20% bear market rally somewhere from June to August this year. So the point here is, do not get fooled by dead cat bounces or relief rallies. The rally that followed the CPI prints was not justified by fundamentals, it's pure euphoria in my opinion. This is why when the Fed officials came out to reiterate their hawkish stance, the market starts to readjust itself. Okay, number 2, inflation is still running hot, very hot, and it's more than 3 times the Fed's 2% target rate. So we can have all the pauses or slowdown in rate hikes in December or early next year. But the truth is, the Fed is unlikely to pivot when inflation number is still far off from their target. Please also note that a slowdown or lower rate hikes could also mean a series of small hikes next year. So don't get too excited if the rate hike drops from 75 basis points to 50 or 25 basis points. This then brings me to the third point, and that is how long does this series of rate hikes need to go on to bring inflation down? To be frank, nobody knows. But that being said, it is widely known that full effects of these rate hikes will take some time, say about a year or so, before they are felt economy-wide. This would also mean companies' businesses, revenue, profits and whatnot will continue to be affected. Therefore, if you were to ask me how's the market outlook for the next few months or even first quarter of 2023, I would say it's too early to call for an end to this bearish market yet. A further dip in the stock market and companies' valuation should not be ruled out. Alright, that's all for this video. Do you think we will have a year-end rally? Let me know in the comments section below. Lastly, if you think my video value add to your research, please help to hit the like and subscribe buttons. Thank you.